Okay, time to answer some questions again from the last market outlook. And again, this week I haven't really seen them coming through. Well, I mean, I know they come through. I just haven't read any of them. I think I read a couple. So some of them I'll be reading for the first time. Let's see, I have a question specific to sector studies. Under your applied levels, would you consider making a generic how to research a sector video? Love the sector studies, and they have served as an excellent foundation prior to doing a deep dive. Earlier market outlook, you did mention that it takes around a month or so to come up with the study material for a particular sector industry. It takes me about 3 weeks from beginning to end. And, there's no real process to it. Sometimes it takes longer, sometimes it doesn't take that long, but let's just think about what I would do first. So let's say that, and I'll explain how I did it for mining. I was going to look at copper mining, and it's always easier to look at one thing, copper miners, a pure play. If you look at the diversified miners, the economics of coal are very different than the economics of gold, which are very different than the economics of copper. So it's a lot that you've got to learn to understand that diversified miner. I mean, you got to understand a lot. Same with the geographies. Where there is coal, you're not going to find gold usually. Gold is in other places. Silver seems to be concentrated in other places. Copper prefers other types of places. So it's really tough to do. So take something that is a pure play mining, and I was looking at copper. Well, who's there? FCX. Okay, 10K. Use the annual report. Start reading. What does this word mean? Google. And I don't go back here until I know what this word means. And then as I'm looking at Google, there's this word. Oh, what does this word mean? Google again. Okay, here's a description of this word. Oh, what does this word mean? Google. And you keep going until you can come all the way back here and you go, okay, I know what this is, and probably a whole bunch of other stuff because I followed a rabbit hole. And you keep reading. Oh, what's this term? Okay, Google. If you're not finding much on Google, what I would recommend you try to do after your search term is type in the words PDF. And you'll tend to get better quality replies with the PDF, because then you get papers. And oftentimes you can get papers by industry organizations, and then that leads you to what the industry organizations are. You head over there, and there's a whole pile of information there as well. Some even have a learning center. So when you get to an industry organization, look for learning centers, or if they have any learning centers, because usually they got a whole bunch of videos there that'll bring you up to speed. But that's what it looks like. It's messy. How do I know when I'm done? When I'm not learning anything new. When I'm reading and it's been 2 or 3 days and I'm looking at different sources and I say, okay, I get all this, I know all this. There's no new terms, there's no new terminology, there's nothing new that's going on. I pretty much got everything. It is frustrating. Your level of frustration will increase as you begin to read, and you'll be thinking, okay, site 1 says something, site 2 says something completely different, site 3 says something completely different. Which one is right? And you start thinking that they're wrong. And you usually are just missing a piece of the puzzle, because site 1 is right under a certain condition. This is a right statement under a different condition or in a different place in the world. And then, once you start figuring it out, your frustration level starts to drop. And right around here is where it all just drops into your mind. It's like, oh, okay, I get it. The other thing is, whatever time frame you have, let's say 30 days, right? This is very critical. 30 days. Relax. Stop. Just relax. Take a day off. Just relax. It's important to let your mind work on what you've already assimilated, and your mind will suddenly start to put pieces together for you. You'll wake up in the morning and you'll have this clarity. It's like, oh, hang on, now I get how those two things work together. Oh, I'm starting to see this now. You need to give your brain a rest. So I'd say you're about 3-4 hours a day on a particular topic before you get bored. Leave it till the next day. When you wake up in the morning, wow, your brain is this wonderful mechanism. It will clear things up for you. It really will. And you just keep going until you think, okay, I got it. That's what it looks like. That's all it looks like, is just a lot of searching. Whenever you go on Google, though, big warning, there's lots out there, and there's a lot of people that have no idea what they're talking about at all. So make sure that you're using legitimate sources. Whatever site you get to, ask yourself right away, who are these people, right? And if it's some 21-year-old kid, telling you that copper mining stocks, penny stocks are going to skyrocket and gives you two good it's just move on, okay? So make sure you're getting it from credible sources that have what's called gravitas. That's it. It is non-linear. It's messy. Depending on the way you frame your question, you may get everything you're looking for very quickly, or you may get nothing, because oftentimes you don't even know what to ask Google. You don't even know what you're searching for. Always start with the biggest company's 10K. Find the biggest company in that sector that's as pure a play as you can get, and read their statements. If you can read their statements and you don't have a single issue going on, then there's nothing to figure out. So that is, let's take GM and Ford. There's really nothing to figure out. They're easy to understand. There's almost nothing to figure out. But you take a telecom company or a pharmaceutical company or a semiconductor or a mining company, you're going to hit all these terms where you say, is this important? Should I know this? Is there a difference between the nanometers? Is there a difference between the type of ore? Is one better than another? Is smelting better than this? So you're left with all these questions. So how can you possibly evaluate this company unless you know all that stuff, right? But auto assembly, there's nothing to figure out there. If I did a video on automakers, I think it would be 5 minutes long. They take in parts, they put together a car, they sell it. There, look at that. I did it in what, 10 seconds. And that's it. It's just that messy. That's all it is. And let's see. How can you be sure that more or less jobs needed to be added, subtracted to get no change in the respective diffusion indexes? Well, the diffusion index is a bunch of sub-indexes. So the index itself has a bunch of sub-indexes, and then it's just a matter of which ones are going up, which ones are going down. And then they're scored so that a neutral position is 50. So if an index is like 52, it signifies growth in that particular index. If it's 48, it signifies contraction in that particular index. So when we look at the jobs that were added in manufacturing, and you look at the manufacturing diffusion index, the diffusion index might be, let's say, negative, showing contraction, but there were positive jobs added, for example. So if there were positive jobs added, but it's still in contraction, that means that a neutral rate would have been more jobs added, because had more jobs been added, the answers to the questions would have been different, such that companies would have reported, well, we're neither adding nor subtracting, right? So if you have more companies that are subtracting smaller amounts and one company that's adding but a larger amount, you could get growth but contraction in the diffusion index, right? Let's see. What are the strategies we can deploy if we feel the market is pricing in cuts too early? Well, the purest way is to use the Fed funds futures, because the Fed funds futures is a measure of what the market is pricing in. So if you think there are too many, then you would short the Fed funds futures, because they are based on 100 minus R. They're an index. So it is 100 minus R. And R is, let's say you're going out to December, and let's say December is 96. That means R is 4%. We're at 5.5. That is pricing in 6 cuts at 96. If you think, well, there'll only be 3 cuts. If we're at 5.5, we'll only get to 4.75, which means the index really should be at 95.25. You would short the index for December. Spike negative carry on the CAD yen short position. It appears to be one of the best forex trades currently available. Yeah, I've given that a thought as well. That the Bank of Canada is more than likely going to signal that it's going to cut rates soon. And I believe that the Bank of Canada will cut rates before the U.S. cuts rates. And I think in Japan there was probably, well, they won't be cutting rates. Let's put it that way. They may not be tightening, but they might, right? And even if they don't tighten and Canada cuts rates, the differential between the interest rates will start to shrink, which should cause the Canadian at the margin to weaken, even if it does nothing to the yen. So the Canadian, you would need more and more Canadian to buy the same amount of yen, or said another way, each Canadian dollar would get fewer and fewer yen. And if Japan does begin to signal that it's about to do something, that carry trade would begin to unwind. The yen would certainly increase. It does seem like an interesting trade. It's likely Bank of Canada will see rate cuts first. Japan is expected to hike interest rates sooner or later. That's the thing, sooner or later. Additionally, the current price levels are at a historic point. Yeah, I think it would be probably low risk. The big risk is Tiff Macklem keeps talking tough with the market, and sentiment drives the Canadian dollar higher, because we did hit 131.90 against the US, down from 138.80 not just 2 months ago. That's a huge strengthening of the CAD against the USD. And after a move like that, there's still sentiment and momentum behind that you could push down. If you have really benign CPI tomorrow, let's say CPI really drops, the US dollar would really drop, the Canadian would gain strength. If there's a belief that the Fed is going to cut rates, the US dollar is the bigger traded one out there. And if it is the bigger traded one, it will have the sentiment. The Canadian will kind of just go along for the ride. You could get down to 130. Right? And if Ueda does not do anything in Japan, contrary to what the market expects, the yen could start heading back towards 150. Well, the combination of these two would be brutal on that trade. So you'd want to play it with a stop. I'm pretty sure you'd want to play it with a stop, but I think there's something there. I agree. Let's see. Would bank liquidity be the most impacted by the reverse repo market contracting close to zero? Or are there other impacts I'm missing? Yeah, I'll explain that one. Also, you mentioned Morningstar is a great tool for ETM/MF research. Do you see Morningstar Premium as being worth the cost? Have you ever used it? If you are a CFA candidate, I believe you have access to Morningstar through your CFA membership. If you are a CFA candidate. Plus, I think you have a couple other subscriptions in there, if I'm not mistaken. Other CFA candidates, please correct me if I'm wrong, but I think you have access to some research tools through your CFA membership. Let's deal with the reverse repo. I'm going to do more of it on Sunday, but I'll give you a quick sort of look at it now. Okay, I'm going to give it to you in the most simplified way that I can without getting into too much detail. Keep in mind that what I'm giving you is very high level. Money market funds. We'll put the Fed down here, and we'll put hedge funds and banks, primary dealers in banks here. When you have high interest rates, money deposits leave banks and head over to money market funds because, well, there's higher return over there. Money market funds buy money market securities. Sometimes there isn't enough securities to buy and they have extra cash, so they go to the Fed with their cash, and the Fed gives them securities and agrees to buy them back the next day at whatever rate it happens to be. 1 day SOFR, which is about 5.3% right now. So instead of looking around for security, they can park money there. The Treasury issues bonds of which hedge funds buy and banks buy, but it takes cash. Well, look, cash has been leaving the banks. So what they do is they enter into repo transactions to finance that purchase. And repos can go this way between money market funds and banks. Repos can go this way between banks and banks, interbank repos, or they can go this way, right? So you go to the Fed and you say, here's some securities, give me some cash, right? Because I need cash. I spend a whole bunch on treasuries and I need to finance them somewhere. Well, look at the flow. You have cash that's leaving the bank into the money market mutual fund, which comes back into the Fed, which then goes back to the bank, all through the repo mechanism. And securities flow this way because the money market funds couldn't find enough securities at that time. They're getting 5.3. They're being charged, whatever it happens to be. Let's cut one leg off. There we go. There's still a need over here. So what are banks going to have to do? They're going to have to start using their excess reserves because they're going to have to come up with the money from somewhere. If as these start to get drawn down, the Fed conducts monetary policy now in what's called an ample reserves regime. So as soon as this hits the zero line, excess reserves start dropping. Is the Fed going to stop at some point and say, whoa, 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 it's getting too low, right? The other issue that we can point to is we've seen over the weeks when we look at cash inflows into money market funds, they've just been going up and up and up and up and up. We know that in a couple of months, the lending facility that the Fed had opened up last year for banks was based on the bank's held to maturity portfolio being underwater with a lot of unrealized losses, because that's what held to maturity is. They're going to hold it to maturity, but with a liquidity problem that they need to come up with money. But if they start selling those securities in the held to maturity portfolio, it calls into question why they're using that category number one. They would lose the ability to hold that category. And then they'd have a whole bunch of fair value losses to recognize, or it would start a cascade effect where other places have to start selling their held to maturities because they're out of liquidity as well. So that's what that facility was for, was to stop that from going on. It was not for a bank that has a whole bunch of bad loans on its books to borrow money to meet liquidity needs. It's not for that. If they have bad loans, they go down, they have their own process that they have to go through, but they can't use this facility. Well, once excess reserves start to begin to drop, that becomes sort of a cascading problem, and these banks may be looking at their held to maturities and saying, well, we may have to start selling that. So it's more than likely the Fed will extend that program and probably start tapering the balance sheet. Once they start seeing this get to the zero line, you're going to hear the conversation of them tapering the balance sheet begin to increase, because they would then become buyers of those securities and keep a level of reserve, or keep a balance sheet level that would allow them to stay in ample reserves and conduct monetary policy. At a high level, it looks like that. There's a lot more detail and a lot of stuff I left out, but I think you get what's going on there. I hope you get what's going on there, but that's basically it, is that you have a need for financing over here. This is a source of financing over here, but it's also a draw of the source of liquidity they had to begin with. Once rates start dropping, it starts to fix that problem. But at high levels, at high interest rates, it's a problem. So if the Fed wants to continue to keep rates high, it's going to have to extend the facility for banks, and going to have to at least have the conversation about tapering QT. Let's go and look at some more questions here. There's my mouse. How do you tie the moves in the Fed funds to TLT? So I really don't. The TLT is the long bond. The Fed funds futures is the expected path of the target rate of the effective federal funds rate. So you don't tie them together. It's just that if there is rates that are expected to drop, the market is pricing in 6. If the market is right, because the market was ahead of the Fed for the last 2 years, why would we believe the Fed? If the market has it right and we're looking at 5 or 6 rate cuts, then the long yields will respond in kind, will respond to the expectation of lower rates. The market is forward looking, and it will price things in that are expected to happen in the future, even though they're not present today. Let's see. I'm trying to understand how much what the market thinks about the overnight rate affects the long end of the curve. It's just sentiment. Fed SCP says 3 cuts, market says 5. Does that mean TLT is overvalued too? To the extent that we think, like we know the Fed funds futures is pricing in 5 because we can measure it. It's 100 minus R. We can measure it. But we don't really know how much the long end of the curve is pricing in. It's inverted, but is it expecting, is it inverted and staying inverted because it is expecting money market rates to drop over the next year because the overnight rate drops? And if it does, and the economy is strong and the Treasury isn't going to issue as many securities as it has, you could get a steepening of the curve while at the same time getting a bull flattener, even though you're getting a steepening. That may sound odd, but let me draw that out for you so that you can see what that looks like. So here's where we are right now. What you could get is short rates dropping, and when short rates drop, the curve tends to steepen, and as short rates drop even more, it does steepen. So rates are still coming down on the long end, but you could also get this going on, right? You could also get this kind of bull flattener going on after the curve steepens because short rates are dropping. If the Treasury is going to issue less than expected and supply is going to be tighter, or the central bank decides to end QT as it's cutting rates, you could get on the long end of the curve that bull flattener after you have the steepener. So how much is the long end of the curve pricing in? Hard to tell. It's hard to tear that apart. Could you make a video of how quickly you come up with SPY year-end targets, what factors go in, and how to consider these? Oh, it was really easy to do. What I did was I said, what would be a reasonable forward multiple today? 18. The forward multiple will give me S0, which is the price today, not ST. ST is the price a year from now, let's say. This is S0. So 18 times earnings would give me the price. But a year from now, the market is going to grow at 1 plus whatever the expected return on equity is to ST. Or I can say instead, what is the expected return that we would expect to get based on where the price is? Well, we know we're going to get some kind of dividend yield, right? And we know we're going to get, there'll be some element of share buyback because it is a thing. I don't see the S&P 500 being a net issuer of shares. I see them being a net buybacker of shares. Small cap index, I would say, would probably more likely to be a net issuer of shares, but not at this level. So there's your income return. And then, of course, you have the percentage change in earnings. Are earnings going to increase or decrease, right? And then you have the percentage change in the PE. So you can start with today's PE and make that a negative term. For percentage change in earnings, you could use what is in, what's within GDP, or you can use the estimate of what earnings growth is going to be over the next year, the consensus estimate. And then you just take your components, you add them together to get some kind of expected return, right? And then from that expected return, you can then determine what you think S0. Now, when I did it here, I took 18. I think 18 is fair for whatever to arrive at a price. 18 times earnings gives me a fair price today, not the market price, but a fair price. And I'm going to use a long-term expected return here. If I start with today's price, today's actual price at, what is it, 19.5 times forward earnings. If I take today's price at 19.5, then I'm going to use the RE I calculated here, which probably would include some kind of PE contraction if we do in fact have low earnings growth. It's just Grinnell Kroner. For those of you at level, who've gone through level 2, you've seen it there, and you see it at level 3 again. I'm exploring gamma scalping. That's interesting as a retail strategy, specifically buying a straddle, then buying, selling stock to maintain delta neutral. Why? Seeing the strategy really ties in delta hedging from level 2 to real world situation for me, so I want to try it. Okay. It's more for a market maker or a dealer that needs to keep a delta neutral book. I like how the strategy offers flexibility in maintaining the position. Do you have any insights, concerns, tips for setting up and managing the strategy? It's super expensive to do unless you're a dealer, or unless you have very, 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 very low transaction costs. But if you're on one of those sites that are $6.99 a trade, the transaction fees will bury you. You could be right and lose a ton of money just in transaction fees trying to delta hedge every day. So you have to have very low transaction costs to get that done. How many days to expiry for the straddle? I don't know. I don't know that I would do that. Yeah, I don't know that I would do that. I wouldn't do it. So, I couldn't even tell you what a good setup would be because I've never, it doesn't occur to me to do that. It's a lot of work to do. Delta hedging is risk management, but you want to bring it from risk management to the strategy itself. That's a dealer strategy. I would sort of think that unless you have a reason to be doing it, why would you do it, right? Get something on insurance within the applied series. Yeah, you will. My goal is to do something on every single industry. The applied series is a multi-year thing. It's not like I'm going to be done by June. I've done, I think, 9 or 10 deep dives in 9 or 10 different sub-industries. There's 163. I just finished communication, communications sector with a deep dive on telecommunications, and that was brutal because it just seemed to never end trying to get my head around what was going on in there. And I'll be using AT&T, Verizon, and TELUS. I have to use all three to tell the story because they all are following different strategies. It took a while to get that done, and spoiler alert: the only winner there over the last 10 years has been T-Mobile. The only winner in the last 10 years has been T-Mobile. Verizon and AT&T dead money, but because they are the beginning and end of everything. What I mean by that is, if you never had the move from 3G to 4G, forget about mobile streaming. Like most of the technology you live with today wouldn't even be a possibility. We wouldn't even be living in that world. It is the great enabler of everything. So you have to understand telecom. You have to understand the technology of telecom to be able to predict what other companies that use telecom are really going to do well. And I just don't think telecom is investable, but it can't be ignored because it's just the enabler of absolutely everything. If you can't get stuff to travel over a network, that's the end of it. That's the end of it. If you never had 3G, if all we had was 2G, we'd all have flip phones and text messaging. That would be it. And we wouldn't know any different. We would think, this is great. Look at my flip phone. No, look at my flip phone. Nokia's on fire. Have you seen? Same with Motorola. We'd still be there. We'd still be there. So to know what's going to happen next, you gotta pay attention to the telecoms. It took a long time for me to get my head around that, thinking about, why am I doing this? These guys are dead in the water. But there's a different reason. But yeah, my plan is to do every single sub-industry. I've got a long life ahead of me, and if I did nothing, I'd be bored out of my mind. And I love learning. I love these sector studies. It's 3-4 weeks of just learning new stuff. It's incredible. But yes, at some point I will hit the insurance industry. I don't know if you can hear the work going on behind me. I think it is hedge trimming day today. Do you plan to make for YouTube or Applied Series videos to help understand and interpret most macro reports? In the market outlook, I've been doing this for about 2 years now. In the very first year, in the beginning, every week I took one report and I tried to, tear it down and tear it apart. There's a lot that can be gained from going back and rewatching some of the Applied series. Yeah, the first couple of screens won't matter, but it's usually in the middle of the video where I would take either PPI or CPI or PCE or the jobs report and show you how to read it and where all the tables are. I guess I could go back to those videos and just pull out those sections and put it into one long compilation of how to read each one. But every week, for the first year and a half, I think I tried to add something new every week, some kind of new thing that once you learned how to do it, you wouldn't need me to do it every time, which is why sometimes now in the market outlooks, I'll just talk about what was in the report without actually explaining what the report was, because I have. Sometimes 2-3 times I've explained what a report was and how to find certain things and how to interpret it. Let's see. I started reading non-farm payrolls for the first time. I have so many questions. Household versus establishment survey. How is it possible that non-agricultural wage and salary workers dropped 803 in household survey, but total non-farm increased 216 in establishment survey? I get the establishment totals are higher as it includes multiple job holders, but still can't wrap my head around how is one rising, the other one dropping. A sampling error is always a thing. The household report tends to have more sampling error than the establishment report, but the methodology is given to you, and if you go to their website, they do have some papers explaining, some research has been done explaining why the difference is, and that if you're looking at the household and the establishment survey month to month, it's probably not the best way to look at it, but 6-month or 9-month averages. So you add up all of the jobs from the household survey over the last 9 months or the last year and everything over the establishment survey for the last year. They do tend to converge over longer periods of time. I think the last adjustment, they made an adjustment a while back to try to bring them into closer alignment. I just forget when, but all these are survey based, so it's methodology, right? So over time you try to improve your methodology without overfitting to a particular time period. I'm not sure if you're right on the diffusion index they compute. They note in the report says 50% indicates an equal balance between industries with increasing and decreasing employment. Yep. He said we determine growth in employment and proportional growth in population. Well, you have to look at them both. You have to say, well, okay, this many jobs were added, and here's where the diffusion index was. So the diffusion index decreased, and there were certain jobs added. So that tells me that if more jobs were added, the diffusion index wouldn't have changed. So we are below where we would need to be for there to be no change, right? Would it be possible to go over to how to calculate the potential gain or loss for duration position? It is theoretical. All it is just theoretical. Unless you're going to break your holdings down into key rates, it's just theoretical. is you put a negative sign in front of things. You multiply duration times the change in yield. So if yields were 4% and you expect them to drop to 3.8%, this will be negative 0.002. Your duration, let's say if it's 16 times negative, and remember, yields down, prices up. So if you want the percentage change in price, you have to multiply by a negative sign to get rid of this negative sign so that you have a positive sign on price. Purely theoretical. Just theoretical. This is just for a change in yield, right? You're just changing the yield of a particular, you're holding a 10-year bond or whatever bond you're holding, you must first know the duration of that bond. So TLT has a duration somewhere around 16, in the average maturity 25 years, right? So you would have to look at the 20 to 30 curve, and whatever the yield is on the 20 and the 30, extrapolate what a 25 would be. So as the 20 and 30 change, you can extrapolate what the 25 change would be, which if you're assuming a parallel change, so the 20 to the 30, and then you say, okay, well, it'll just do that, a parallel change, and so will the 25 year. Then you just multiply it by duration and take the negative, and there you go. It'd give you a rough number, but again, it's purely theoretical, right? Being that they're treasuries, the actual change, your empirical change, which is empirical duration, should be probably somewhat less, a little bit less than what theoretical duration would be. What are your thoughts on if a retail trader were to focus his time on one asset strategy sector as a way to develop more specialized knowledge, which is, I've always recommended this, is I talk about it as the rings of risk, that usually when people come to the market, they take on the riskiest positions first. But if you do something like this, right, here is SPY, right? Each of these are the 11 sectors. Here are all the sectors. From the sectors, you have specialized ETFs, and then you have sub-industries, even more specialized sub-industries, and then you finally have stocks. And when people come to the market, they tend to buy stocks, right? And I'll buy this stock and this stock and this stock. Well, this has the most idiosyncratic risk. And when they start buying stocks, typically they cluster within a sector, so they might be very concentrated in IT. And consumer discretionary. And if you're into Facebook and Google, you'll be in communications as well. So you're in three sectors, and you have the most risk. But if you start at the level of SPY, you have a diversified portfolio of 505 large cap stocks. How much better can you get? You might say, well, I only have one stock. No, you don't. You have 505 stocks. You have a market weighted portfolio of 500 of America's largest companies, profitable companies too, because that is a requirement to be in the S&P 500. And you will trade SPY until you get comfortable with it, and then you'll say, you know what, I like SPY, but right now I know that these two sectors are probably going to do better. Well, you don't know, but you have a feeling. So you might lower your amount that you have in SPY and raise the amounts that you have in these two sectors. Because SPY has these sectors in there anyways, what you're in fact doing is overweighting two sectors. So you start playing around with, well, I'm going to underweight and overweight some sectors. And eventually you get to know a sector really well that you feel that you can step into some of the more specialized ETF industry ETFs or sub-industry ETFs. So this is the sector, this is the industry, this is the sub-industry, this is the stock. And then you eventually, start working your way out until you're comfortable enough holding particular stocks. Yeah, one asset strategy sector is a way to develop more specialized knowledge. I wouldn't take one stock and do that. If you're going to do that, you want this asset to be diversified, so you're using an ETF. So much information readily available, I find it hard to narrow down what to specialize in. But then doing so comes at a cost of never being able to capitalize on the other trending markets. Well, you can't be everywhere, not without a staff. You can't be everywhere. You can't know everything. You simply can't. There's you're going to have to let a whole bunch of things go, and you're going to have to find some place that you're comfortable. There's opportunity everywhere. You just have to be somewhere. Trying to chase the next big thing, that's hard to do. That's brutally hard to do. But within a particular sub-industry, trying to figure out who the winner in that sub-industry is going to be is not so difficult. If you confine yourself to your own little sandbox, and you don't try to, travel all over the place, you'll do fairly good. When you start spreading yourself too thin and start getting involved in a whole bunch of things you don't understand, that's when everything starts to fall apart. Would you happen to know of any individuals who are hyper-specialized in how they traded and were able to achieve success over a long time horizon? Well, I mean, nothing comes to mind right now, but nothing really comes to mind right now. Thanks for your analysis. Can you elaborate on why the Fed will have to look at easing QT? Oh, already did that. Any comments on MPW? Not really. I haven't been following the REITs, the medical REITs. So not really. Overwhelmed trying to understand the interaction between money market funds, money market yields, overnight rate. Okay, already did that. Would you trust a substantial part of your net worth in Wealth Simple? I don't know what Wealth Simple is. If not, what Canadian institution would you put it in? I don't know. I don't know the answer to that. Have you noticed Malaysia is also territorial tax? Don't want to go to Malaysia. Don't want to go. I've heard, sorry if you're from Malaysia, I've heard nothing good about Malaysia. That if you're going to be there, you may as well be in Singapore. But I've heard nothing good. Question for you about your move, being a resident of Costa Rica. Do you have to remain there 6 months a year? Well, I have to be, well, that's a good question. Do I have to remain here? Probably not. I don't have to remain here, much like I don't have to remain in Canada 6 months a year. I just can't remain anywhere else 6 months a year. But let's say I'm Canadian citizen and I spend 3 months in Costa Rica, 3 months in the US, 3 months in France, and 3 months in Canada. Because I've not exceeded 6 months in any one country, I'd probably still be considered a resident of Canada. Because no other country is going to give me residency if I'm not there for 6 months or more. So to get residency, you have to say, this is where I'm going to be. You need to be a resident somewhere, right? Unless you're going to surf on these, what are they called, nomad visas, where you go to each country for like a year at a time. You're a digital nomad. You make your money online. That's living out of a suitcase, because you can't really put down roots. You can't really buy anything because you're going to be gone in a year, maybe every second year, right? So, I don't know. I think to divorce from CRA, I do have to be a resident somewhere else. And, just because I'm a resident here doesn't mean I have to stay here. But I think there is some issue about, coming to a country just to set up residency and then leave. That if that's what you're doing, I know Canada has some issues with that, where there are especially money from China coming into the country, setting up residency, and then simply just leaving and being a resident of another country without actually residing in that country. Canada may have specific rules about it. I don't know if CR has any specific rules about it. If you had an additional property somewhere in the world, you could spend a third. Yep. Also, without retaining your home in Ontario, could you address retaining assets in Canada along with being a resident? Yeah. So it's especially for your primary home, you lose the capital gains on it, right? So let's take a period of time. Let's say it's 10 years, and there are 7 years in which you owned your home, and 3 years like you were a resident, and 3 years where you were a non-resident. Right? Whatever you sell your house for, 3/10 of the cap gain is taxable. Now, what sucks is what if you did this and you sold here? Well, you've actually you can't really make the argument that, hey, when I left, my home was worth 2 million. I only sold it for 1.8, so I actually have a loss. If you paid 1 million over here, this 800,000, you'd owe 3/10 of the 800K without any consideration for what happened in there. That would be the drag. That would be the disappointment, right? So the other thing that sucks is, let's say you are going to value it. Let's say you're going to get a valuation and it did this. Well, that sucks too, right? I mean, that sucks too. So you're hoping that it just continues to do this, or it has to sort of go on the same trajectory so that what you had over here is not taxed. This here is truly tax-free, and then for the next 3 years you had nothing but gains. What you don't want is to be at the same level or lower, because if it goes sideways at this point, over time you're just giving more and more of your capital gain to taxes, but it turns into a taxable asset, not a tax-free asset. Regarding the establishment report for December, now, before I leave here, here's an interesting question. I don't know the answer to this. Let's do this again. Let's say 7 years. Let's go out to 12 years. And let's say that here I'm a Costa Rican resident, here I'm a Canadian resident. I've made all my money by this point in time. I come back to be a Canadian resident. My income in this period of time has had 0 tax, and I'm very happy. And I've owned my home during this period of time, and it's done this. When I sell it at this point in time, because I am now a Canadian resident, would the CRA still say, well, there is 5 years of which you owe us some capital gain? Or would I now be a Canadian resident and all of this would have just been, a period of time that is forgotten about? I wonder if that's the case. I don't know. I don't know the answer to that one. That's interesting, though. Establishment says the numbers were revised down quite significantly for October. Yep, that's true. And November down from 199 to 173. True. Explanation that revisions are due to additional reports and seasonality. Am I correct in assuming that such large revisions downwards probably mostly due to seasonality? I don't know if I would say they're mostly due to seasonality, but updated estimates of what the seasonal component is, probably better data over time. So what we have is, you have a report, a jobs report, right? But you have other reports that sort of triangulate around there. So if this one is off a little bit, you can triangulate. I'm just doing this, just as a visual. You could sort of just triangulate and say, okay, well, maybe it should have been closer to here. So that if the estimate was here, you'd say, well, okay, it has to move here, based on what all the other reports are that would add more precision to the estimate of this sample that you got, right? So as you get a whole bunch of data in, the other data may say, wait a minute here, now we got a bit of an outlier here because it doesn't seem to fit the pattern anymore. So there's a little nudging and pushing and adjusting, and it's you got to talk to a statistician if you really want to do a deep dive on that stuff. It gets super boring super fast when you get into the statistics of it. Super boring super fast. Chapter 3 in any textbook, in any stats textbook, that's the title of it. Super boring super fast. May as well get to it. Was that done there? Explanation revisions are due, am I correct? And in your view, could there be issues with the types of adjustments given the last 3 years of arguably being anomalies? Yeah, I think that we probably don't have a good handle on what the seasonal adjustment should be. And I think that this will probably go on for a couple more years as we go back to a regime in which the adjustments would go back to the way they used to look like before the pandemic, right? Let's see. Best idea is you point that last decade we had QE and near zero interest rates without inflation. And it should not be different now if we have an expansion. My understanding before the pandemic, global liquidity didn't reach the consumer. It rarely ever does unless it goes through the banking system into loans. Banks were the loser of 2008 financial crisis. Credit formation was anemic after 2008. Bulk of liquidity were contained in financial markets, bidding up bond prices and stock markets. Yep. At the same time, we had low prices of oil thanks to fracking. Yep. I agree. When the central bank floods the market with liquidity, the investor class always wins first. Always. Inflation depends on the relation between money with goods and service. Theoretically, that's one theory, but okay. Technology improves the supply of goods and services, but if liquidity grows much faster than supply, inflation should be expected. No. How would you say that money's growing faster than supply? Ask yourself, what is the supply limit on online streaming? All right, I mean, what's the supply limit? There's no inventory. You don't run out. It goes on and on and on and on and on, right? What's the supply limit on digital advertising? Well, it just goes on and on and on. There's no limit to how many times you can print an ad. It's only when you get to physical services and goods that you do have that sort of limitation. But what if you live in a world of abundance in terms of the ability to produce that? The only reason we had issues is you shut down the whole global economy and then turned it back on again. Not everything turns on at the same time. So once the economy is up and humming again, if you're not going to shut it down, there's no shortage on where you can get stuff done. I don't know that more money would induce inflation in a world where where a larger and larger part of what you engage in are services that have diminishing costs to scale, not increasing costs to scale, but just diminishing costs to scale, that as you add more and more people, costs just keep going down. There is no inflection point where you then have increasing costs to scale. There are no diseconomies of scale. I can't see the logic for all that money. When you say too much money chasing too few goods, that was in a time when goods made up maybe 40-50% of the economy, where manufacturing was much bigger, where the global marketplace was much smaller, where if you were out of steel, there weren't very many opportunities or places to go to. South America, you wouldn't really discuss too much. India wasn't where it is today. China was non-existent, and half of Europe was behind the Iron Curtain. Where are you going to go? Right? It was a world with much less capacity. Not so now. So, I don't know that if Milton Friedman were alive today that he would be as convinced as he was in the 70s and 80s. After the pandemic, the inflation was caused by supply shortage, massive liquidity injection, fiscal deficits, and maybe animal spirits in the behavior of the consumer. I think that's not your view. What do I miss? Can you share your thoughts about? Well, I think we live in a deflationary world. Technology has always been deflationary. It's always driven down the price, the unit cost of things, at least, the unit cost, because it increases productivity. That's the whole point of it. If it didn't, it wouldn't be technology. It wouldn't be invested in. If it could not increase my productivity, I don't know why I would ever buy it as a business. So, given the nature of competition, as long as you can keep competition alive, the competition will drive prices down, because if you're not willing to lower your prices as your margins are increasing, somebody else will. When selling options for theta, calculate the prospective return. Should I include in the denominator the margin requirement? Yeah, but remember, your margin requirement, you're using T-bills, right? You're never just going to use cash. You're going to use T-bills. So if you keep it in like 7 to 10 day T-bills, you should always have some source of ready liquidity. but you'll keep it in T-bills, which has a yield. So your numerator will be your theta, plus whatever yield you get. Your denominator will be the amount of cash, but I would not use the proceeds from the sale because that's not your money to begin with. It wasn't your capital to begin with. Even though it's restricted, it wasn't your cash to begin with. Use whatever cash you had happen to that you have to put up. To your comment about energy benefiting from Middle East uncertainty, I want to add the maritime industry within industrial is also benefiting. Yeah, you gotta charter those ships for longer if you're going to go around the Cape. Is there a video on your channel of the Applied series discuss the reverse repo? I believe there is, and I think it would be in sector studies, either in the top down folder or in the financials folder. Sitting on 20-year strips up 15-16%, part of my fixed income SAA, but I'm getting tactical. Is there an argument to switch out of a few of these holdings because a lot of upside has already been realized? I don't think so. I don't think a lot of the upside has been realized. Love the 5% yield to maturity for 20 years, but now with limited remaining upside. Is there an argument to take? Well, you're making the assumption there's limited remaining upside. You know, you have to think out over the next year. You know, is there limited upside over the next year? Not only that, you have to think about the role of that in your portfolio. Is the role of the fixed income allocation in your portfolio to earn that nice return? Or is it also to get a return and provide a hedge against your equity position? That if the market did crash, whoa, you'd be wanting to have those bonds. So, you know, if it's forming part of the balance in your portfolio, I wouldn't touch it. Yeah. Applied series. Any plans to do pay? Yeah, I'm going to be doing almost all of them. When? I don't know, but it's just a labor of love. It's just going to continue on. Except for the period every year between March and about July to August, right? L3. I do the new content for the next year for L3 between those two dates. What's your strategy? You get India and Mexico exposure. Mexico you can get with EWW. There's got to be an ETF for India. If not, what you can do is you can there's a Mexican index, major market index. There's an India major market index, and within Mexico and within India there must be a peso denominated ETF like SPY in the US that tracks the major index in Mexico, and there must be an INR denominated ETF that tracks the major index in India. Anybody out there who happens to know what those are, go ahead and put them in. With IB, you can trade those. You don't have to have an Indian broker to do it. If you have interactive brokers, you can trade in the Indian market. Not a problem. Can you explain the Fed reverse repo indicator? I already did. Any data points and/or events materializing that would confirm a macro bet trade for you in 2024? Earnings would be the only thing. If earnings come in and they're just wicked and forecasts are just off the top because costs are being whittled down and revenues are solid, then yeah, probably. Do you think you do deep dive on RRP? Already did. In your analysis of year end, you didn't mention the impact the election could have. Other times, the way the year finishes during a U.S. election is driven by changes in party. Any thoughts on what the election cycle could do to markets? Yeah, so, you know, I'm thinking back of the last two elections, and on the announcement of the winner, there's major disruptions, and then la-di-da-di-da, a couple days later, okay, let's move on. It doesn't seem to be a trend, it seems to be an event. You trade events, you invest in trends. I don't think that an election cycle is an investable thing. I think it's a tradable thing. What the trade is, I don't know. Beats me. But it usually is short-lived. A lot of volatility on the evening of the announcement in Globex, in the bond markets, in SPY, in the US dollar, and then it just sort of settles out. Because I don't think it matters which clowns are in control. It's just that we have clowns in control, right? What is your take on the exponential increase in bank utilization? It's probably just, as we've seen, money market mutual funds just keep drawing in money. And that's probably coming from bank deposits. And so that's probably what it's for. It can't be for bad debt. It can't be for bad loans. That wouldn't qualify. So it has to be for something benign like that. How do you calculate the percentage amount to overweight a specific sector? Let's say, for example, I want to allocate 50K to large caps and overweight XLU. Well, then it's just your judgment. It's your judgment about how much you want to overweight on that one. Let's see. I have a class on the economics of Canadian healthcare system this winter semester, and your commentary I was more than interested in that when I registered. As a 22-year-old Canadian going into the winter semester, I'm curious to get some insight on what a day for a 22-year-old Mark looked like and what his reaction may be if he was told where he is now. 22-year-old me was very much into school, but in an opportunistic way, not in a strategic way. If I had to go back and do it again, I probably would be more strategic. Opportunistic meant I selected my schedule for easy A's. Any numbers course I took. They were easy A's. I hardly had to work at them. They were just easy A's. Accounting, finance, economics, operations research, all that kind of stuff were just easy A's. And then, of course, you have to take the other courses, HR, marketing. There's all these required courses. And I thought, well, I'll just get by as best I can in those. Those were, I never really, did as well with the numbers courses. B's were my strategy there because A's were tough because it just wasn't my thing. But numbers, I just structured my schedule to have all these numbers courses so that when I finished, it was like, great, I know a lot of stuff about numbers. But I didn't have any one real big focus, right? I knew I didn't want to be an accountant after, because all I had left was tax and auditing, and I thought, no, I don't want to do that. I can't ever see wearing my pants above my belly button. I would not make a good I would not make a good accountant. So I just decided, finance. I was cool, and the cool people did finance. That's just it. But that was 22-year-old me. What was his reaction if he was told where he was now? Hopefully nobody ever tells me what my future holds. I don't want to know, even if it's fantastic. I don't want to know, because if I know, I may not put in the effort required to get there, because I would think that my future is that anyways. What am I doing this for? My future is this. I already saw it. I've already been told this is where I'm going to end up, so I probably would end up screwing it all up. Sometimes it's not knowing what your future is going to be that makes you dig deeper to create the future that you want. And that if you could go back 10 years and tell yourself 10 years ago where you would be today, I would say, don't you dare do that. You're only going to screw yourself up, right? Never, ever reveal, if you can go back and talk to your younger self, unless the future's bad, never reveal what the future looks like, because you would change the behavior of the individual and almost nullify the future. So I don't know that I would have wanted to hear it. But then again, 22-year-old me probably would have wanted to hear it. But, this is what age and wisdom give you, is sometimes it's better not to tell people the whole truth. Given your range for the S&P 500, what do you think about selling in December 2024, put at 4,000, selling a call at 55? That's a wide spread. Software shows a probability of 77%. That's just based on the distribution, right? But that's not based on any kind of forecast. It's just the distribution. Much better than a coin flip. It is. It is much better than a coin flip, which is the kind of trades that you want to set up. I don't know how much money is in that trade, though. Being that you're so far away from the strike, I don't know how much money would you be getting paid for the risk that you'd be taking on. I don't think you get paid enough. There's an ETF with low AUM that holds multiple ETFs as an underlying. On their own, all the underlying ETFs have significant assets under management. On such a case, when the intent is to buy and hold, should a retail investor be concerned about the low assets under management of the ETF? Well, whose ETF is it? Right? If it's someone's ETF you've never heard of, then yeah, I probably would avoid it. Low assets under management, what's the expense ratio? Because if you're holding it long term, it's not the transaction cost, but the expense ratio that's more important to you. Is it 50, 60, 70 basis points? That's a lot. On its own, low assets under management is not really a big deal. It's just not going to attract a lot of money into it. But if it's just an ETF of ETFs, keep in mind you got two layers of fees, right? The ETFs it's holding all have a layer of fees, and then the ETF itself is going to have a layer of fees. So now you have two layers of fees. Rather inefficient. What is the use of the forward multiple? Because the market buys the future. So how much are we paying today for the next 1 year of earnings? How do you calculate real rates? Take the nominal rate minus the tips rate. So take a 5-year nominal bond and subtract out the 5-year tips rate, and that'll give you the expected inflation. For real rates, take the nominal rate minus the expected inflation, and you'll get to a real rate. The market is close. Market going to close in with Fed's 3 rate cuts. Would TLT go higher? TTT go higher when TLT go low? TT, you mean Fed funds futures? I don't know what that is. We'll move on. Unless TTT is another ETF, of which it is. I'm not familiar with what TTT is. What do you think about investing in Russell, or a growth version of it like VBK, since small caps underperformed 2022-20? Small caps never do well when interest rates are high. They're least capable of refinancing debt. And they typically have shorter term debt, and they typically have secured debt. So they don't do very well when rates are high. And to stay afloat, they typically do share issuance more often than not. So you have that to contend with. Small caps are great to get into when rates are well underway of being cut. Not when they just start to be cut, but when they're well underway, when the cutting is well underway, then small caps become interesting. Why the auctions of treasury bills or bonds important? Because if the 10-year yield is 4%, I answered that, by the way. If the 10-year yield is 4%, then the auction clears at 4.1%. 10-year bonds will correct very quickly, within seconds. And that's a 10 basis point hit to the price. The price will drop very quickly. So if you are holding bonds, keep in mind that the announcement of auctions is a risk event, right? What's your forecast for the U.S. as well as the Canadian? U.S. I think weakens into the end of the year because they'll be cutting rates. Barring any global major risk event, the U.S. should weaken. The Canadian, I think, will probably hold its own against the Canadian. I don't see it breaking out past 130 down to 125. But I also don't see it getting to 140 and over 140, but I think 132 to 136 would be its home for a while. What source for economic calendar do you follow? There's lots of economic calendars out there. You just have to Google it. I use Daily FX, Daily FX, as in foreign exchange. Why an increase in geopolitical tensions would cause an increase in the value of energy? It's not that an increase in tension causes it, it's where that tension happens. And that tension is happening in the region where a lot of the oil is, right? So disruptions on shipping could happen very quickly, which means you'll get supply shortages. You think semiconductors would similarly increase in value if China were to escalate tensions with Taiwan? Would they increase in value? Well, that increase in price. If there was a concern about that, prices would begin to increase. Yeah, absolutely. Do you have any view on ISM services sector employment contraction last week? Your indicators are never going to all say the same thing. When they are all saying the same thing, you can be pretty sure that there's something going on. But you might have 5 different indicators where 2 are saying, hey, it's good, 1 is kind of blah, and 2 saying no, it's not very good. So it's not uncommon to get data sources that are in contradiction. I don't know that I have a view on it. How is the implied volatility of the S&P calculated? Based on 30-day expiration, and it's done using the front month and the second month contracts. That if then they're weighted based on how many days to expiration each one has, so that you have a 30-day weighting. You don't have to know how it's done, but it's based on at the money options, 30 days to expiration, and the implied volatility that is on those. Here it is 54% going up by 11. Well, no, that is implied volatility percentile that I'm quoting. I did answer that one. So when we look at 13-week implied volatility percentile, so here's the highest it's ever been. Here's the lowest it's ever been in the last 13 weeks. IVP is here. It is above the last 40. It's above 45% of all of the observations. So when we say it's the 45th percentile, it means that it is, that of all the observations in the last 13 weeks, 45% of them were below where IVP is. That's all that is saying. What's going to cause the housing stocks to go down, but Lennar didn't? I don't know. I didn't look into it. Investor relations, Lennar, and you'll find some press releases. If it was an accumulation of a fund, then you'll find nothing. Then it was some kind of technical feature of the market as opposed to a fundamental thing from Lennar. Are you aware of NNN REITs? Nope. CFA level 1 market efficiency video say active management is a waste of time. We can't beat the market. Why do you trade then? Well, you have to understand what active management is. I don't do active management. Active management says, here is a benchmark, right? You may be thinking, what do you mean you don't do active? Let's define active management first. Here's the benchmark. Passive means I just buy the benchmark. So if the benchmark's the S&P 500, I buy SPY and then I'm done. That's a passive investing strategy. I will get whatever the market returns. Active, on the other hand, says I can do better than this, but it's still your benchmark. So that means you're limited to investing in the same thing the benchmark invests in, except you'll overweight some things and you'll underweight other things. That's all you do. And some things you'll equal weight, and you hope to beat the SPY. That's active management. Hedge fund style management has no benchmark. This is what I do. It has no benchmark. Your benchmark typically for a hedge fund would be a cash rate plus basis points, maybe about 400 basis points. So that would put your benchmark at 9.5%. That's what you got to beat. No matter what the market is doing, you got to beat that. That's your benchmark. So because I don't have a benchmark, I would not call myself an active investor. An active investor means that you have active positions. Well, active positions with respect to what? Right? If you don't have a benchmark, any position is an active position. So you must have a benchmark. So in the industry, when we talk about passive and active, it is benchmark aware. When we talk about hedge funds, there is no benchmark involved. 2024 market will either go up or down. I agree. I absolutely agree. And that's it. That's it.